You ready to go?
Yep, let's do it.
Let's go.
Okay, so welcome back, Mr. V, founder of MarketEdge and guru of all things technical analysis. Let's discuss today our strength indexes. So last week we talked about momentum index. Today, let's talk about the MarketEdge strength indexes.
Okay, well, before we can get to those, Rachel, I want to go into our market letter, which is on the homepage, down at the bottom. And this is updated every Friday night. And this is where we tell you what's going on with the market and mainly what's going on with our market timing models. And as you can see, as you scroll to the bottom, MarketEdge uses 3 market timing models. I developed all these back in the mid to late 80s. And the dominant model is what we call our cyclical trend index. And this is backed up by our momentum and our sentiment indexes. Now, underneath the sentiment index, we have what we call our strength indexes. And there's 3 of them, one for the Dow, one for the NASDAQ, and one for the S&P. Now, what happens in real life, we get about 3 significant market calls a year, 3 or 4. And it's usually up, down, up, or down, up, down. So over 52 weeks, we change them, every 3 or 4 months. And we've been doing that on the MarketEdge site since 1993. So it's over 30 years, and we get it right. Not every wiggle, but we get the main change of direction right about 75, 80% of the time. Now, what happens in real life is that just because we like the market, we're bullish on it, that doesn't mean it's going to go up for 14 weeks in a row. The stock market doesn't work like that. Conversely, when we don't like it, it's not going to trend down for 13, 14 weeks in a row. What it usually does, it'll have a move and then it'll consolidate, have another move, consolidate, and this will go on, over a 3 or 4 month period. So maybe about 20 years ago, to get a conviction level on the current market posture, whether we're bullish or bearish or neutral, we developed what we call our strength indexes. Now, these are pretty clever. Very few people pay attention to them, but they make a lot of sense. And basically what our strength index is we take the 30 stocks in the Dow Jones Industrial Average. There's 100 in the NASDAQ 100, and there's 100 in the OEX, in the S&P. And every week we measure based on a couple of our proprietary indicators whether the individual stocks in that index are under accumulation or distribution. Accumulation means that there's more volume going in on up days than down days. Distribution's the opposite. More volume is transacting on down days than on up days. So what you end up with is a number. It's either positive or negative. So a positive number, signifies that the stocks in the index are under accumulation. So then what we do is we take the 30 stocks, let's say in the Dow, we divide that by the number of stocks that are under accumulation, and you get a percentage. So you can see on the chart, this is as of last Friday, as far as the Dow goes, 46.8% of the stocks in that index are under accumulation. The prior week, it was 38.6%. Now, we still have that rated as negative because it's less than 50%. Next is the NASDAQ 100. There's 42.6% under accumulation, also negative because it's less than 50%. And then the S&P is quite a lot lower, 39.7%, also negative. So what goes on in the world is that when we have a bullish call and you're seeing negative strength indexes, it's not confirming the move. It's telling you the call is proper if it's bullish, based on our cycles, our momentum, and our sentiment. But what the strength indexes are saying that the odds favor probably a sideways move over the next week or two until these numbers change. And it makes a lot of sense. I mean, if you have 30 stocks in the Dow Jones average and 25 of them are under accumulation, meaning more volume coming in on up days than down days, the odds are pretty good that index is going to trend higher. So that's what the purpose of strength indexes are. They come into play probably about 50% of the time. Usually they're pretty much like they are right now, right around the neutral to slightly negative, slightly positive connotation. But it can really help you out if you're looking to make some major moves in the market to know that when everything is in sync, everything's going your way or half of it's going your way. And that's what we do with it. So, oh, I want to show you this. Let me hop over to the second opinion. You could say, well, how do you guys know, whether it's under accumulation or distribution? Let me pop the stock into second opinion. I'll show you. Here's one of everybody's favorites, NVIDIA. And you come on down to our volume analysis, and you'll see the third one down, it says up-down ratio, and it's 1 for NVIDIA. And you'll see that underneath that is the up-down slope, which is up. So the ratio 1, meaning that there's more volume on up days into NVIDIA than on down days. And the slope is just a linear regression of that number, of that ratio over about 30 days, and it's pointed up. So it tells you not only is the ratio positive at +1, but that the trend is also up over the last X amount of days, which is a very good thing. So we do this for every stock in the Dow, the NASDAQ, and the S&P every night, divide them by the total number of stocks, and we come up with the strength index. Does that help you at all?
That sounds great. So if I only had to worry about one of these indicators that we've talked about today, the one I should look at is the up-down slope.
That's correct. You really don't care what the ratio it is. You care what the trend's been. The ratio can go up and down, 1 minus 1, 1 minus 1. But over 20, 30 days, if there's a lot more ones than minus ones, the slope's going to be up, which is bullish.
Great. Okay. Is there anything else regarding the strength indexes or the up-down slopes and up-down ratios that we should mention today to make sure our viewers have the most comprehensive picture of how all of these pieces work together?
Well, you just hit it on the head in that there are a lot of pieces to pretty much just about everything we do. But if you understand where it's coming from, it makes a lot of sense. So you can hop into the Market Letter Weekly every Friday night after the close and take a look at the first column under the timing models. And you can see 0, which is neutral on the cycles, +4 on the momentum, which is good, -5 on sentiment, which is very bad, negative. And then you look down and you look at the strength indexes. And, if you can add, you come up with 1, 2, 3, 4 bad things, 1 good thing, and 1 neutral thing. So your guess is that if you're looking to buy a lot of stock the upcoming week, you might want to hold off for a while until things turn around a little bit.
So that brings up a really good point. As these indicators are all starting to shift negative, or rather less positive, we'll say, and I'm looking to get into several different stocks. Does Are these more leading or trailing indicators? Should I wait until they're positive to get in, or is this sort of the idea of buying when things are on sale? It's all negative, so maybe it's on sale and now's a good time to get in because they're cheaper because the stock market's looking a little further south.
This is the $1,000,000 question. The answer is it's not black and white. There's been studies done for years and years and years that will tell you that between 70 and 80% of the listed stocks, let's say on the NYSE, will follow the overtrend of the market. Meaning, over a 30-day period, if the Dow or the S&P go down 10%, about 70, 80% of the stocks on the exchange are going to be lower 30 days later. Same thing works on the upside. Now, a stock is a stock. It's an independent animal. But what you're trying to do here is I always go back to the weatherman analogy. If the weatherman comes out and says, hey, look, there's a 70, 80% chance that it's going to rain tomorrow, the odds are you're going to take an umbrella with you. Now, it might not rain, all right? But you're going to take your umbrella. And over time, that weatherman gets it right about the same as we do with calling the market, about 70 to 80% of the time. So it's more or less wouldn't dictate. I mean, if you really like IBM today, I'd go ahead and buy it, but no matter what this is saying. But understand that you're probably fighting the environment, and you're better off if you wait a while. And a while isn't usually that long. 3, 4, 5, 6 weeks, something like that.
Okay, so I understand the weather analogy and I understand the independent, stocks are independent animals piece. But if I'm looking at this and trying to predict, is this the 10-day weather forecast or the hourly weather forecast?
In that scenario would be the 10-day.
Okay.
Now, what
And
can happen? Let me tell you what can happen. We can have a bearish market posture. have it, let's say it's been bearish for 4, 5, 6, 7 weeks, whatever. And all of a sudden on Friday, you look at these strength indexes and they're ticking up considerably higher. Well, that's telling you that the stocks, the majority of the stocks in those indexes are being bought, accumulated. And the odds are good that our market call is going to either change soon or, be subject to an opposite move within the call, meaning we're bearish and now you get a rally for 2 weeks. Okay, we're bullish, now you get a decline for 2 weeks, depending on these strength indexes. Because this is the purest thing as the stock market is whether stock's under accumulation or distribution. And you're looking at these indexes, all the stocks in those indexes, evaluated every Friday as to what the case is, and it has significant value over the short term. So I guess the answer to your question is it's 10 weeks over the big market posture picture. This could be 1 week over the short term. Does that make sense?
Very good. Yes, that makes sense. Thank you.
Good.
All right. Anything else we should cover?
I think that's enough for today. What do you think?
Sounds good.
Okay. I'll see you next time.
If you have questions regarding the MarketEdge strength indexes or any of the technical analysis indicators available on MarketEdge.com, feel free to send us a message at support@MarketEdge.com or drop a comment below and we'll get back to you as soon as we can. Thanks so much for your support. We'll see you next week.